Hello, everyone. Welcome back. Today, we're going to be talking about defensive investing and some of the key elements that I would recommend you incorporate into your overall investment strategy and stock selection process, especially if you believe that we are, entering a period of low growth or even negative growth at the macroeconomic level. If you believe that we are entering recession, or if you believe that the economy overall will slow down for a period of time, what are the investment strategy inputs that you should definitely have as a part of your stock selection process? So let's take a look at that. So, as we've been talking about over the last several months, the macro picture remains mostly bearish, especially if you look at things like the Treasury yield curve. Right now, the yield curve is inverted. Every single time that has happened in the last 50 years has been followed on with an economic contraction that's usually bearish for stocks, as well as typically leads to a risk-off environment. Inflation expectations are decreasing. That's consistent with the view that the economy is moving towards recession. And, if we look at, say, for example, the price of gold, tips, the copper to gold ratio, inflation expectations coming in from the New York Fed, these are all indicating that expectations for inflation are coming down. But at the same time, there is some good news. There are, production gauges such as the Chicago PMI, ISM manufacturing. They're both still expansionary, but the rate of change has slowed quite significantly from when they were at, just about a year ago. So, as more and more sort of indicators are, sort of mixed, it used to be that, most indicators were bullish. That's what led to very, very low equity risk premiums just about a year and a half ago. And therefore, PE multiple expansion across the board. That has come in quite significantly over the past year as the Fed has been aggressively hiking interest rates. And at the same time, these forward-looking indicators of inflation have been in check. And so, this is that yield curve that we've been talking about. You can see that's had a very, very strong track record at getting ahead of recessions. And it's, flashing recession warning right now, just like it did back in 2007, in the year 2000, in 1988, and also in 1980. So it's, again, a very, very good track record. This is the 10-year Treasury yield minus the 2-year Treasury yield. So whenever that number goes below zero, it's, traditionally been a very, very good recession indicator. And that's exactly what we're seeing now. So, and then, of course, the two items that I mentioned, ISM Manufacturing Index and the Chicago PMI, you can see that they're both still above 50, so that's good. But, that rate of change is slowing every single, month really for the last year. And the Chicago PMI really kind of fell off in the most recent print down to 52. So these gauges are coincident indicators. They're not going to give you a warning ahead of time. And so therefore it kind of tells you the state of the economy right now, as opposed to where the economy is going to be, a year from now. But you can see that rate of change is slowing. So the trend is very important to watch. And right now the trend is negative. And so we'll see where these numbers end up, but the trend is not favorable. At the same time, mortgage rates have now crossed 6%. And, both Redfin and Zillow, who have a pretty good pulse on the housing market, especially the residential housing market, have all reported that there's been record numbers of cuts to list prices. So, sellers are now cutting their prices from the list price, and it's taking a little bit longer for homes to be sold. The wait times have increased, inventories have risen, and there's been a great number of cuts to list price. And so that's, indicative of, mortgage rates, hitting levels not seen since really 2008. So again, we think this is yet another, headwind to economic growth. As housing prices fall, that's yet another hit to economic growth, because again, home prices are a big reason for how consumers can establish sort of at least paper wealth in order to be able to, say, for example, borrow against the equity that they have in their homes, and use that for spending. And again, consumer spending is such a big part of the economy. So as housing prices get hit, that should have reverberating effects throughout the rest of the economy, as consumers and borrowers end up borrowing and consuming less. So what is the plan of action? So this is how I would personally navigate my equity portfolio. What you want to do is make sure you're picking companies. I would perform a full top to bottom review of every company that you own in the portfolio, and basically ask yourself these sets of questions. Are they needs over wants businesses? Are they defensive in nature? So if, say, for example, disposable income were to drop significantly, as what typically happens in a recession, are the companies that you own going to be able to survive that? So do you own too many nice to have businesses, or do you own critical needs businesses? So that's the first question. And sort of a follow on to that is, even if it is a wants business, do they have a very strong runway for growth? Right. So you have to be, in this, area where companies that you own have a very high conviction. You have a very high conviction in their ability to grow even through a recession, right? So that has to be the case. Typically, defensive companies are the ones that have that highest conviction. But, ultimately you want to be able to, look at the companies that you own and be able to say, yeah, they will most likely be able to continue to grow revenue and earnings, even if the economy were to contract because of XYZ reasons. And usually the easiest way to answer that question is whether or not the company is defensive in nature. So do they make products and services that are needed by consumers all the time, regardless of if there is a recession or if there is a boom period? Usually defensive companies are the ones that are able to survive and weather recessions the best. So we want to make sure we can check that box off first. Secondly, what's been their track record? So have they actually shown, once you've established that they are defensive, then you want to look at the next part of it, which is that, let's take a look at their track record. So have they shown consistent revenue and earnings growth through recessions in the past? You want to see that earnings certainty over time. We want to be able to see steady earnings growth and free cash flow growth, even through past recessions. So how did they do in 2020 versus 2019? How did they do in, for example, 2008 versus 2007? Were they able to grow through those exceedingly difficult periods? If the answer is yes, then you've got a winner, or potentially a winner. So we can continue on to this next set of questions. So we want that track record. Have they shown consistent earnings growth in just about every market environment over the past 15 years? And I like to look for 15 years because that, gives you a full, synopsis of, just prior to the 2008 great financial crisis and the entire, 12-year bull market following that. So you want companies that are able to adapt to both, deep recessions as well as, perhaps the greatest bull market of our adult lifetimes. So, you got both ends of the extreme there. So you want companies that have thrived in both environments, throughout, both time periods. And then thirdly, do they consistently generate high returns on invested capital? Right? Studies show that companies that can consistently produce high ROIC outperform those that, generate low ROIC. So again, you want high ROIC because, as interest rates rise, the cost of capital rises. So it becomes more and more difficult for companies to add value. So remember, companies only add value if they can generate returns on invested capital that exceed the cost of capital. So that is the economic value added or economic profit that the company generates. So again, you want companies with high ROIC because those are the businesses that can sustain an increasing interest rate environment. And just today, for example, we had the Fed reiterate that they want to they hiked another 75 basis points today, so we're up to 3.25% in terms of the Fed funds rate, and they're committed to rising that to to 4% and beyond throughout 2023. So the Fed again is committed to increasing interest rates regardless of if there's a recession or not. And so as interest rates rise, the cost of capital for companies rise. And therefore, businesses that generate high returns on invested capital are the ones that are able to weather these macro headwinds the best. So I personally like to look for companies that have returns on invested capital, and you can define that as free cash flow relative to invested capital. And invested capital is basically, total assets, minus the non-interest bearing current liabilities that the company has. That number should be something above 8%. That's usually the rule of thumb that I like to use. Because currently I believe that the cost of capital is about 8% right now. So if you have companies that are just at the borderline of that, we want to be very aware of that. But, anything in excess of, say 10% is relatively safe. So you want companies that have, high and consistently high. That's the other key. It has to be consistent. Companies that have high ROIC in the short term, may be, doing okay, but, if they aren't able to defend that for a long time, then competition can come in and replicate what they're doing and take away that business, that advantage that they have. So you want companies that have consistently generated high ROIC. Typically, I like to look for at least 5 years. Have they had at least 5 years of an average of 10% or more ROIC? So that's very, very important as a part of the overall step-by-step process. Fourthly is, in a period of low growth, you'll have likely low returns from equities. And so the companies that have the best dividend growth will also, are more likely to outperform than those that don't have, any dividends or, are prone to cut their dividends. So do these companies generate consistent dividend growth? And I should have added to this list, but also you want that dividend to be less than the free cash flow. So therefore that gives the company a lot of leeway as to grow that dividend even through the recession over the next year or so. So you want consistent dividend growth, and you want free cash flow to comfortably exceed that dividend. The fifth point is that we want them to be low beta. This is also very important because high beta stocks also tend to have high cost of capital. So low beta dividend growth, high ROIC, consistent earnings growth, defensive companies. These are all very, very important characteristics to have in a low growth or negative growth macroeconomic environment. So typically defensive companies tend to have low beta as well. But I wanted to include that separately because you just never know. Sometimes there are defensive businesses, but they've got a lot of, debt on the balance sheet. And so that would introduce some financial risk. So if you have low beta as well, then, that accounts for, all the other types of risks that surround the company. So we want that beta to be low. And what's defined as low? Well, anything below 1 is low, but I'd rather be a little bit lower than that, say under, 0.8 or so. And then lastly, this is very important, probably, just as important as everything else, but you want them to have a, low PE or low price to free cash flow multiple versus their own historical averages. This is very important. Why? Because you may be able to check off all of these prior boxes here, but a lot of companies that have these high quality characteristics like defensive, needs over wants, consistent earnings growth, consistent free cash flow growth, consistently high ROIC, consistent dividend growth, low beta. Companies that have these highly desirable characteristics have had their multiples expand quite significantly over the past 10 years or so. And so what we want to do is introduce that last characteristic so that we're not picking companies that have had significant multiple expansion. Why? Because, those companies could continue to have, very strong execution even through the recession. But if they have a high PE or a high price to free cash flow entering the recession, then you could still have negative returns on your investments in these companies if multiples continue to compress as they have been for the S&P overall. So you have very high quality companies out there, show negative returns right now. Why? Because they entered the year at a very high PE relative to their own historical averages. So the key is to look for companies that have a PE multiple today or a price to free cash flow multiple today that is in line with their own historical averages. And by historical, I mean at least 15 years. That way we get, the full bull and bear cycle captured in that time frame. So who are these companies? So I ran a screen that looked for these types of companies. It's not just a screen that I ran, but it's also a little bit of, sort of qualitative work that I put into it to, pick companies that, have more or less all of these characteristics solved. And here they are. These are the high quality businesses that are built to weather recessions, but also ones that trade at reasonable multiples to free cash flow and to earnings. So this is a handpicked, group of companies. These are all members of the Zacks Earnings Certain Portfolio. So they've all have that highly desirable characteristic of consistency in earnings growth, very high quality companies that generate, just phenomenal returns on capital. They are defensive in nature. Their earnings are not, correlated to the broad business cycle. They have very strong moats. They have consistently high ROIC as a result of that. And they currently trade at, very reasonable, multiples to earnings and free cash flow. And they also have, very attractive dividend growth over time. So I think that this, basket of, what is this? 4 plus 3 is 7 plus 2 is 9. These 9 companies, I think, will have a very, very high likelihood of outperforming the S&P 500 and NASDAQ, over the next 12 months. We can just take a look at some of these here, just to give you an example. I have, Linde here. This is their price to free cash flow. Look at where they trade at. You can look at and see that they currently trade at 20 times their free cash flow. So this is the important thing to note. There's no absolute number that you should look for. So when I say low PE or low price to free cash flow, there's no, magic number. So I'm not saying to look for stocks that have below 15 or below 20 or below 10. What you need to look at is where their multiple is in relation to where they always have been over time. This is important because different companies deserve to trade at different multiples. So, I don't like this tendency that people have, which is to look for a low PE in absolute terms. These are high quality companies, right? These are companies that generate very, very strong returns on capital. They have, essentially an impenetrable moat around their business, either through brand value, like in the case of Coke and Church and Dwight, or R&D know-how, like Amgen, or AmerisourceBergen in terms of network effects and volume, ICE in terms of basically being one of very few, large exchanges out there in the world, right? The exchange is an incredible moat to have because there's only so many exchanges out there. American Tower, right? They own over 200,000 properties all over the world. And they have long-term leases, typically 10-year leases that are signed by their tenants who typically are the largest mobile carriers out there, like Verizon and AT&T and T-Mobile and others. So again, these are companies that have very high, they are defensive in nature. They service needs over wants. They have demonstrated consistency in revenue and earnings growth even through recessions. They consistently generate high returns on capital. They also have very consistent dividend growth and free cash flow that backs that dividend growth. They are all low beta, and they all trade at very reasonable multiples right now. So again, I believe that, because of all of these characteristics being checked off here, these companies, I believe, will provide significant protection for investors, as we enter and navigate through the next 12 to 18 months of increasing interest rates and highly uncertain outcome on the macroeconomy. Again, we just saw, the Atlanta Fed, who manages the GDP Now forecasts. They've been, cutting their estimates for growth, consistently all year. And we've already had 2 quarters of negative real GDP, and it's highly likely that we get a 3rd quarter in a row for Q3. And so this is going to lead to, further estimate revisions to the downside for companies. I believe that'll start happening as we get Q3 results. But, there is increasing likelihood that, in a slowing growth environment, these are the types of companies that will outperform. So this is what I personally recommend doing right now, is to sort of implement a step-by-step investment strategy around these principles right here: quality, defense, and reasonable multiple. So hopefully this was helpful. If you need these slides, I'd be happy to send that to you. You can email us directly with any questions at zrs@zacks.com. And if you are a advisory tools client who I'd love to hear from you, please email us at zat@zacks.com. All right. Thanks, everyone, and hope to see you on the next one. Take care.